Good morning all of you. Today's class we are going to discuss about financial accounting. Our subject financial accounting. Our first topic introduction to financial accounting. You know there are three branches of accounting, mainly three branches of accounting: financial accounting, management accounting and cost accounting. Our study is confined with financial accounting. You know, what is bookkeeping? The process of recording and summarizing financial transactions is known as bookkeeping. The process of recording and summarizing financial transactions is called bookkeeping. When this data is produced in report for the use of individuals or companies, when these data is produced for the report of the use of individuals or companies, they are outside the organizations. This process is called financial accounting. Let me explain one more. Bookkeeping is the process of recording and summarizing financial transactions. When these recorded transactions produced in reports, these recorded transactions produced in reports for the use of individuals or companies, these recorded transactions are produced for the use of individuals or companies, they are outside the organization. This process is called financial accounting. Let's see the definition of financial accounting. According to American Institute of Certified Public Accountants, AICPA, the world famous definition of accounting given by AICPA. According to them, accounting is an art of recording, classifying and summarizing. Accounting is an art of recording, classifying and summarizing in a significant manner. In terms of money, transactions and events which are in part at least of a financial character and interpreting the result thereof. This is a world famous definition of accounting which is given by, this definition given by American Institute of Certified Public Accountants. Accounting is an art of recording. Art of recording. Recording means every transactions are first recorded in a book which is called a journal. All business transactions are first recorded systematically. This book is called a journal. Then after recording these transactions, we have to classify all these transactions. Then summarize this transaction in a significant manner. Transactions and events which are in part at least of financial character. Please see, transactions and events which are in part at least of financial character. Only monetary transactions are recorded in accountancy. The transactions which can be measured in monetary terms can be recorded in accountancy. Then finally we interpret a result from the recorded transactions. Transactions are recorded, classifying and summarizing. Then finally a result extracted from these recorded transactions is called accountancy. Then next we are going to study about the basic terms or the basic terminologies related with the accountancy. Basic terminologies related with the accountancy. Let us see first one, business transactions. First term, business transactions. What do you mean by business transaction? Business transaction means the dealings of a businessman with the outside parties. Business transactions means dealings of a businessman with the outside parties is called a business transaction. For example, purchased goods. Purchased goods is a business transaction. Sold goods. Sold means sales. Sold goods is a business transaction. Paid wages, paid salary, received commission, like that, etc. are considered as the business transactions. These are dealings of a businessman with outside parties. These business transactions are mainly classified three types. Business transactions are mainly classified three types. First one, cash transaction. You know cash transaction. What do you mean by cash transaction? When we purchase a product from a retail shop or from a shop in your local area, then you paid cash on the spot. It is called a cash transaction. So cash transaction means immediate payment of cash. Immediate payment of cash. Purchased goods and payment of cash made immediately is called cash transactions. Then second one is that credit transactions. What is credit transactions? When we purchased goods, the payment of cash is postponed for a future date. The payment of cash is postponed for a future date is called credit transactions. Then another transaction is barter. Third one, barter. This transaction which was prevailing in the world. Barter transaction. Barter transaction means one item is exchanged for another item. One goods or one things which is exchanged with another item is called barter transactions. These are the three types of business transactions. Cash transaction means immediate payment of cash. Credit transaction means payment of cash is postponed for a future date. And barter transaction was prevailing in our world. Barter transactions prevailing in the world. What is barter? One item is exchanged with another item is called barter transactions. So, first basic term used in accountancy, business transactions. Business transactions are three types. Okay. Then next one, capital. Capital. You know capital. What do you mean by capital? Capital means money or money's worth introduced by the owner into the business. Money or money's worth introduced by the owner into the business. At the starting time of business, the owner introduced some cash or goods. Cash or goods. Suppose a proprietor brings 5 lakh as capital into the business in the form of 2,50,000 cash and 50,000 furniture and 1 lakh building and 1 lakh stock. He introduced cash and cash worth into the business. It's called capital. Capital means money or money's worth introduced by the owner into the business. It's called capital. Clear? Then next term used in accountancy, number third, drawings. Drawings. In accountancy, drawings means cash or goods. Cash or goods withdrawn by the proprietor. Proprietor means owner of the business. Proprietor from the business for his personal use or for his domestic use. Cash or goods withdrawn by the proprietor for his personal use is called drawings. Not for business use, he withdraw cash or other things from the business, cash or goods from the business for his personal use is called drawings. Next term, debtor. Debtor is a debtor. Suppose a business sold goods to Mr. Raju on credit rupees 2,500. Business sold goods to Mr. Raju on credit rupees 2,500. Mr. Raju owes some money into the business. Here, Raju is considered as the debtor of the business. So, who is the debtor? Debtor is a person who owes money into the business. Debtor is a person who owes money into the business. Okay. Then next term used in accountancy, creditor. Suppose a businessman purchased some goods from the suppliers. A businessman purchased some goods from the supplier. In this case, a business owes money to the supplier. Here, business owes money to the supplier. Here, supplier is considered as the creditor of the business. Supplier is considered as the creditor of the business. Okay, please see, who is the creditor? Creditor is the person or a business firm to whom the business owes money. Creditor is a firm or an individual to whom the business owes money. Clear? Creditor, debtor. Okay, see, next term regularly used in accountancy, assets. You know assets. Asset means things or property owned by the business. Asset means things or property owned by the business. Assets are mainly classified into two: fixed assets and current assets. Assets are mainly classified into two: fixed asset and current assets. Fixed asset means assets purchased for the permanent use. Assets purchased for the permanent use of business. Current asset is purchased for the temporary purpose. Current assets are the assets which are purchased for temporary purpose. What is asset? Asset means things or property owned by the business. Assets are two types: fixed assets and current assets. Fixed assets, examples of fixed assets are land, building, furniture, machine, like that, etc. Then examples of current assets, cash is considered as a current asset, debtors is considered as current asset which can be converted into cash quickly, bills receivable stock, etc. are considered as the current assets of the firm. The next term regularly used in accountancy, liability. Liability means cash or things owed by the business to others. What is liability? Liability means cash or things owed by the business to others. Something cash or other things owed by the business to others is called a liability. Like assets, liabilities are also classified into two: permanent liability or long-term liability, or current liability or short-term liabilities. Permanent liability or fixed liability or long-term liability. Then second one, short-term liability or current liability. Long-term liability and current liabilities are the classification of liabilities. Next term regularly used in accountancy is closing stock. You know closing stock. Closing stock is the value of unsold goods. It is the value of unsold goods lying in the business at the end of the financial year. Value of unsold goods, not the quantity, it is the value of unsold goods laying in the business at the end of the financial year or at the end of the accounting year is called a closing stock. Then next term, purchase. Purchase. Normal life we use purchase is buying something. Buying something, to buy something. But in accountancy, purchase means the goods which is meant for sale. In accountancy, purchase means goods which is meant for sales is called purchase. Next term used in accountancy, sales. You know sales. Sales is the major source of revenue of every business organization. Sales is considered as the major source of revenue of every business organization. So sales means sold goods for the purpose of earning revenue. Sold goods for the purpose of earning revenue is called sales. These are the basic terms used in accountancy. I hope you understand well. Let's wind up the class. If you have any doubt, please post your doubt in the comment box. Okay, see you.